Welcome to the Techno Fundamental Report for September 11th. We're doing a day early simply because of hurricane conditions. Don't know if I'm going to lose power today, but we'll see. Now look, we have to understand that the markets are driven by the large institutional investors. And if you don't recognize that fact, then it's unfortunate, because that's the biggest advantage that we have as small investors, is that we can understand what they're doing and so forth. So you can see the big footprint. They just to make a point that they're bigger than us. Now, when it comes to human emotions and studying human behavior, it's all about fear and greed. And right now we're seeing a lot of fear. And if you think about the Great Depression, which was terrible, horrible situation, Franklin Roosevelt brought us pretty much out of the bottom of the economic activity by this one statement. He said, first of all, let me assert my firm belief that the only thing we have to fear is fear itself. You see, what happened, and this is all about human behavior, it's about a spark of fear. And so you had this company called the Bank of the United States, and they were a very popular bank in Brooklyn, New York. And it started to fail. And the Federal Reserve did not come in and rescue this bank. So when the depositors lined up to get their money out, and they couldn't get their money out, it sparked a total collapse of the financial system in 1929, where 30% of the cash out there, meaning money supply, basically disappeared and went into mattresses. So it created, the human behavior created a panic. So the difference between a recession and a depression is, there's an old joke saying that, a recession is where your neighbor loses his job. A depression is where you lose your job. A depression is caused by basically what I can tell would be a bank run, and it's triggered by human behavior. Bull markets are born on pessimism, grown on skepticism, mature on optimism, and die on euphoria. The time of maximum pessimism is the best time to buy, and the time of maximum optimism is the best time to sell. Interesting quote by John Templeton. Now, one other thing I wanted to point out is the SOM rule. We just got, last week, unemployment numbers. And all the SOM rule is really saying is that when you start to see abnormal increases in unemployment, it historically has been a warning of a coming recession. So if you kind of go back to 1960 here on the SOM rule, and you might want to pause your video player to understand the calculation, but I just go with it. This Claudia Somm is a very respected analyst, and I know she back-tested this. So if you go back to 1960s and you get into the early 70s, you can see where the SOM rule got back above 0.5 recession. 0.5 recession. It has called every recession since 1960. And so maybe it doesn't work this time, maybe it does. But it is calling for a recession as we speak. Now, it gave the initial signal back in July, but pretty much confirmed it in August. The other troubling thing is things when you watch Dollar General stock drop 30%. My goodness, this is supposedly the most defensive area you could want to be. Then you see where these financial companies announced just the other day that they're starting to see problems with consumer credit. This is Ally Financial. They do a lot of car loans primarily, and you can see what has happened here with this stock. Now, also, even J.P. Morgan had a pretty precipitous decline here. Now, it's holding its uptrend, so I believe this is going to be a strong situation. This could even be a buying opportunity. My point is, the banks are starting to look iffy. Now, I want to talk about the aggression index. This is an important indicator that I started studying this indicator back in 1995. Did not start to apply it until after the 2008 financial crisis. So, it's been a study for me for a long time, and I have found it valuable to understand. So here's the NASDAQ divided by the consumer staples. It's a simple, simple formula. Now, if you notice here, I've got moving averages, and I have the 10-week and I have the 40-week. Now, this is the 2000 dot-com bubble. And you can see this indicator basically collapsed. I mean, it came down like a rocket. However, the indicator even became more important as you broke below this moving average, then you broke below this moving average, and then you got what you call the death cross, which is where the 10-week crossed below the 40-week, and you can see what basically happened. The dot-com bust was one of the worst experiences I've ever gone through, and I wish I would have been using this indicator. Now let's go look at the 2008 financial crisis. Now, there are analysts out there that are saying that the financial crisis was caused by Hank Paulson and the fact that he did not bail out Lehman Brothers. Now, it's back to like the Bank of the United States. You start to get this calamity that's not resolved quickly. Like back in the 29, the Federal Reserve failed to come in and save that bank and prevent, a spark that ended up being a fire. Now, again, on the aggression index, I go back to 2006. You can see we got the death cross there, but this one's a little bit trickier because we came down, stabilized, and then started going again. But boom, we get the next death cross, and you can see what has basically happened. So let's look at to where we are today. This was the 22 bear market. This is when interest rates went from 0% to 5%, and the NASDAQ dropped approximately 40%. So this was an important signal. And we were using this indicator, and it really made a tremendous difference in our performance in this particular given year, which was a bear market year. So you can see you broke below the upper moving average, then you broke below the lower moving average, then you get the death cross. Well, here we are today. We've broken below the upper moving average, we've broken below the lower moving average, and now we're starting to see the death cross. So all I can say is what I see. I'm not trying to predict anything. I'm simply saying that I'm seeing the fact that the Psalm rule has kicked in, that we're seeing dramatic drops in financial institutions, and we're seeing even Dollar General drop. So the other thing that I'm noticing here, and I'm just noticing these things, I'm not taking dramatic action on anything. I'm just simply saying these are observations. The price of oil is really coming down here, and it's gone into the pink. We talked about this last week. So the price of oil is dropping. Why? Maybe because it's looking for an economic slowdown. We'll see. Now you can see here with the energy stocks, which is the XLE, you've basically gotten a sell signal there, and the energy stocks are definitely in a downtrend. New lows, too high. Above 40, I get uncomfortable. I'm uncomfortable here. Now, if we go and look at the two primary indexes, and I'm using something called a power trend analysis, which is where I'm using the 21-day exponential moving average, and I'm using the 50-day simple moving average. So the NASDAQ, what's bothering me here about it, we made a high, now we're making a lower high, so it's looking like a downtrend. So we never got the power trend buy signal on the NASDAQ, and you can see that the 21-day continues to not act as well as I would like. Now on the S&P, we did get a power trend buy signal right in here. So you can see that the 21-day is moving above the 50-day, and the rule is that if the 21-day breaks below the 50-day, the power trend indication is negated, and it's no longer a power trend buy signal, which we're still on. So you can see, though, it's probably, unless the market rallies today, it's probably going to break below and end the power trend buy signal. So I wish I had better news. It's just the way things are, and we have to only can deal with what we see, and we have to deal with this on a day-by-day basis. So if you have any questions, please let me know. Thank you very much.